Good morning, traders and investors. It is August 5th. We got the market starting to move. We got some interesting price action unfolding yesterday. Members, we got a sell signal to exit our QQQ, or more so our QLD trade today at the opening bell, which is going to work out very nicely. I'm going to cover kind of the sentiment flow, but long story short, our QLD trade from our entry price is up over 32% this morning at the open. And we'll be closing that out. Now, sentiment, the tide is turning. There's some pretty interesting things starting to unfold. Let's jump into the short-term price action of what we've seen and where I think yesterday's bounce in this bar is going to be. Yesterday's bounce is probably going to have most people feeling really bullish. They're expecting the markets to go higher. And we're doing the exact opposite. Yesterday was a FOMO day, so our FOMO indicator, which I show in my book, Technical Trading Mastery, how to set this up, how to use it. When we have FOMO, that means everybody's piling in. And I saw this with our inbox indicator, the comments coming in from people saying, how are we having a trend change in the NASDAQ on such a strong day? And part of that is, well, we don't look at the current day for analysis. The current day is pure reactionary. It is just what's going on now. It's a reaction. Yesterday was a FOMO day. We look what's been happening for the last several weeks, and more or less the momentum and everything has to shift. There's a lot more than just the current day's price action. And yesterday created FOMO. Everybody's bought in yesterday. They didn't care what price they bought into the market. And I was saying yesterday in the afternoon update saying, we'll probably see the market's gap higher today because the people who were working and didn't get in yesterday are going to have FOMO, and they're going to put in a buy order and drive the market up in pre-market, and we're going to open higher. And we are set to open anywhere from almost 0.6% to 0.5% higher. And what could very much so happen here is the market gaps higher. Everybody, the last people who didn't get in from yesterday, the very short-term traders, they buy at the high, and then the market sells off, fills the gap, and potentially goes down in a bigger way. Now, believe it or not, this scenario that's unfolding right here is actually very similar to this scenario right here. Now, the market could just push to all-time highs. Nobody knows, but our analysis is saying close position, lock in the profits, and wait for a fresh new setup to get back into the equities. And we're going to move our money elsewhere to protect it and just make sure we don't give back any more gains than we have to. And that's kind of where we are from that perspective. Now, a few things did come into play. So we had the previous day, we had the market close with panic selling, which typically means if we have panic selling, it's kind of the opposite of FOMO. If everybody's dumping shares, short-term traders, they've driven the market down, they've exited, usually the market's going to bounce. So not only that, but we had this lime green area. This is an oversold market condition saying, hey, the market is oversold. It should have a bounce when we're in an uptrend. So we had oversold, which again is an indicator I share in the book. And we have the panic selling, and that told us yesterday we're probably going to see a bounce in some type of move higher, which we got. If we actually look at the put-call ratio back on this day, this sell-off day, when people were dumping shares, we saw the put-call ratio. It doesn't look like much, but it gapped up higher and moved up. People started buying put options. People quickly went from being super bullish, buying calls, leveraging themselves, thinking the market's going higher, to one day they flip and they're like all buying put options, betting on the falling market. When people are betting on a falling market, usually it goes the opposite way. And so that's kind of what, that little scenario that has unfolded. And if we go back to the S&P 500 here, and I pull up our short-term cycle indicator, you can see when we have the lime green are stronger cycle lows. These are much shorter cycle lows in the market, and we just had another lime green cycle low. So these are very short-term cycles. It only means the market has to bounce for one day. Again, this short-term cycle analysis goes more or less with the 30-minute chart, but we had that cycle low on this close. It carried over yesterday, and the market is trying to bounce for just a short-term bounce, which is what we had yesterday already. So a lot of things kind of lined up for that. Now, let's take a quick look at the sentiment chart. If we look at the sentiment chart of the it doesn't matter if it's the SPY or the QQQ, which is our gauge for the NASDAQ here. If we go back, we'll just go to the SPY. If we go back here and we take a look at our sentiment chart on the right, these deep red bars I mentioned yesterday in the video saying, hey, there's definitely some change going on. This means there's more so, I said yesterday, blood in the streets. That's why they're deep red. People are worried. They're starting to, people who literally bought recently are under pressure. There's some big institutional selling, some big volume selling going on, a lot of things behind the scenes. This can lead to, obviously, like the big sell-off we had earlier this year. So there is a bit of a shift going on behind the scenes. Even though yesterday's stock market moved higher, we still saw things breaking down behind the scenes. And that's what the stock market does. It does camouflage. This big rally day has most people thinking the markets are going higher, has them very bullish. They're going to pile in today at the open and probably pay a higher price, only for the markets to collapse and fall and go down, and then they'll eventually shake out and take a loss. So sentiment is definitely giving us a warning as well that things are changing underneath the hood of the markets. Now, we had a member wondering, what do we do with our with other positions that people have? A lot of people one of the members said semiconductors, and I think that same member has semiconductors. They have the SOXL ETF, which I think is the semiconductor stocks. It's just large caps or something. I'm not sure. They also have Tech L, which is another tech. I do want to mention something here. If you have semiconductors, I'm just going to pull it up on this chart here. Let's just take a look at this. SMH, this is where so many people go wrong, especially when you fall in love with a sector like uranium or precious metals, and miners and stuff like that. This is where most people really fall into this problem. If we take a look at semiconductors there, let's insert a symbol. This person also has SOXL, which is, get rid of some of these other indicators. This is the semiconductor bull, 3X. So it's the same thing, just with more leverage. And they also want to know about the Tech L. Let's see what this symbol is. This is the technology long. Now, if you notice, we could just move in. If you zoom in, they're all the same. These all move the same, give or take a percentage difference here and there. Obviously, 3X will move roughly 3 times as much. But I know a lot of people that do this. They get into semiconductors, and they buy the SOXL, and then they buy the Tech L. They buy like a gold mining stock, and they buy a whole bunch of gold mining stocks and different ETFs. The silver miners, the gold miners, all of that stuff. They're all the same trade. When it backfires, you blow up your account, and that is the problem. People, you don't just layer in different ETFs and stocks in the same sector. You pick one or two that are similar. Make sure you have proper position sizing. You don't just buy a whole bunch of the same things. All of these are going to tank at the same time, so just be aware of that. Now,